WiseTech, the Australian-listed software company, recently announced that it's maintaining its full-year forecast, but it has renegotiated the terms of some of its recent acquisitions. The stock's doubled from its March lows, and it appears that the market is now buying back into the story. However, having reviewed some of the announcements, we see some very worrying trends, and we still struggle to understand why anyone would want to pay 15 times sales and 300 times business cash flow. Particularly when WiseTech is now failing to grow its core customer revenue, where the sales return on assets is collapsing, margins are declining, and there's little if any real cash flow. It also appears that the total addressable market is a lot smaller than the company implies. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. In our December review, we outlined many of the key governance, accounting and peer performance issues at WiseTech, so today we're only going to focus on what's changed. Please watch the earlier videos if you want to get the full background into WiseTech. Governance. Mr. White, WiseTech's controlling shareholder, has added yet another office rental contract to his current portfolio, further boosting the cash he takes out of the company. We're not sure why WiseTech is unable to organise its own property affairs, but the potential for a conflict of interest is obvious. Accounting. Over the same period, WiseTech reported that while EBITDA rose 29%, EBITDA margin fell to 30%. The problem we have is that this EBITDA is a number that management can make up at will. In fact, much of the increase this year came from increasing the capitalization rate for their development expense. They also benefited from a change in accounting standards. The EBITDA margin would have been 24% had they used the same methods they used a year ago. Worse, it would have been 13% if they fully expensed the development costs like their industry peers, Manhattan and Descartes. And it would have been zero or worse if they expensed their customer acquisition costs, i.e. the goodwill that comes from their M&A. Of course, capitalizing costs make sense if they can be shown to add value over the long term, but this is not what is happening at WiseTech. Their return on assets has fallen so far that today each new dollar of assets only generates 25 cents of sales, 6 cents of EBITDA, and 3 cents of post-tax net income. If this trend continues, they'll soon be unable to fund any more growth. Part of the reason for this is that their acquisitions are just performing worse than expected. Usually this would be bad news and the asset would be written down, but at WiseTech they managed to turn failure into a new source of profit. A normal person would say if you pay less for an asset than you expected because you know the asset is now worth less than you thought, you should cut the value on the balance sheet. WiseTech has taken a completely different approach. They kept the acquisition price the same, even though they now know that it's overvalued, and booked a profit because they're paying less than they originally agreed. As part of this revaluation and repricing review, they also persuaded some of the sellers to take equity instead of cash, effectively doing a backdoor placement. This is odd because only 4 weeks ago they were saying they had no intention to raise capital and they had plenty of cash. It seems they're actually far more worried about their cash balance than they say. Performance. Perhaps the greatest threat to the WiseTech story is that their rapid growth phase may be over. They already have relationships with the top 25 global freight forwarders and 40 of the top 50 global 3PLs. If these are the top players in the logistics industry, it's probably safe to assume that these customers would account for most of the potential market for logistics software. This brings up several issues. First, any new customers will be relatively small, so new wins will produce incremental rather than rapid growth. Next, 3 of the top 3PL customers appeared to have trialled on and then trialled off over the last 6 months. This would seem to suggest that CargoWise is not as essential as management wants you to believe. And finally, revenue from these market leaders and core customers fell in the pre-COVID first half FY 2020. It seems that while WiseTech can buy new customers, it's not clear that they can persuade their current customers to spend more. One of the intriguing differences between WiseTech and a normal SaaS model is that WiseTech charges a minimal subscription fee and then bills depending on usage or deals processed. This encourages users to sign up, which may explain the low attrition rate, but it doesn't necessarily translate into subscribers being heavy users or using CargoWise as their only software solution. Looking forward to the second half results, it's probably safe to expect that the deals processed by WiseTech's top clients fell, given the collapse in trade volumes and their market share of those volumes. Management says they've offset this with new customer wins and deeper penetration. The problem is that this new business would appear to be at much lower margins. We've already said that we think reported margins are a nonsense, but even if using management's forecasts, it looks as if margins will fall to 26% in the second half. Put another way, the 22% year-on-year growth in revenue generated zero EBITDA growth. This is not the sort of operating leverage that you'd expect to see from a SaaS company. If you want to dig a little deeper, please visit the WiseTech page on Bucephalus.com using the link below. There you can see the questions we think investors should ask and download some recent filings where we've highlighted the key points. To keep up to date with our reviews, subscribe to the channel or send us an email. Before you go, please remember none of this should be taken as investment advice. We've sourced the facts from company documents, but the interpretation and conclusions are just our opinion. We provide these videos for education purposes to expose what we perceive to be creative accounting. They are subjective and should not be used as the basis for an investment. Thank you for your time.